Hello, Matthew Bell with InsurancePrescription.com, and today I wanted to talk to you about the Rule of 85. Now, the Rule of 85 is not a rule in the same way that the Rule of 72 was. In a previous video, we outlined the possible uses for the Rule of 72 as kind of a handy estimator of the amount of time it would take for an investment to double, or the amount of time it would take for prices to double given a particular rate of interest or rate of inflation. However, the Rule of 85 is nothing like that. What the Rule of 85 essentially is it is a component of some defined benefit or pension plans that enables the person to calculate whether they're eligible for an early retirement. Now, just a word, a defined benefit plan is different from, let's say, a defined contribution plan as the 401k is, as a 403b might be, and so on. When you think about retirement savings, and I've said this in other places, you essentially can think about three different things. Firstly, you're going to put some money in to a retirement vehicle. That's usually called the contribution. Then that money is going to grow, hopefully, even though there are generally no guarantees, especially if it is a market-connected vehicle, then all bets are off in terms of a guarantee as to whether there will be any gain in the account at all. But in principle, it will grow. And then the third period is the benefit period, or the period during which you take withdrawals or distributions. The lingo differs depending on the actual retirement plan in view, but those are generally speaking the three periods of time. Now, when you listen to that language, you hear there's a contribution period and then there's a benefit period. Contribution is what goes in, the benefit is what goes out. So in a defined benefit plan, it is the portion that goes out that is guaranteed. So a pension differs from a 401k in a very important respect. The pension is a guarantee of a particular amount in your mailbox, in your bank account, your paycheck, guaranteed for a particular amount of time in retirement. Often there is an actuarial calculation that is performed. It may be something like, if you worked for the company for 25 years and you had a $100,000 salary, then the company will guarantee to give you 85% of your salary for the rest of your life. So in that calculation, your pension would be $85,000 a year. A defined contribution plan, on the other hand, does not guarantee what goes out. It guarantees only what comes in. And usually, it is a conditional guarantee. So for example, many employers will match. If you put in some of your salary into your 401k plan, for instance, your employer may match that amount, put in a little bit of money as well. So if you put in 1% of your salary, the employer also puts in 1%. If you put in 3%, maybe they put in 3%. Now that would be a dollar for dollar match. Many matches are different. They might be 75 cents for every dollar, they might be 50 cents per dollar, and there's often a cap. So maybe they'll put in 75 cents for every dollar up to 8% of your salary, something like that. I get into this in other videos. I'm not going to repeat it here. If you're interested, I'll put links in the description where you can kind of dive into the details of 401k, 403b, 457b plans that operate fairly close to this. The Rule of 82 in general does not apply to defined contribution plans. It applies to pension plans, and these are less common today. Figures vary. I may flash a few of the numbers up on the screen if I can locate them, and they seem to be diminishing every year. The prevalence of the pension plan certainly has been replaced since the 1970s when the 401k was first rolled out. The 401k is now far more widely available than pension plans are. Whether that's a good thing or a bad thing, this video is not going to get into. But suffice it to say that these defined benefit plans have largely been replaced by defined contribution plans. But where you do have a defined benefit plan or a pension plan, there could be something like the Rule of 82 that is operative. Bear in mind that the actual number, 85 here, is not a magical number. This is going to be something that is actually set by the plan documents itself. So this is an internal rule. It's internal to the company, it's internal to the corporation, it's internal to whatever the pension plan is. The number could be 75, it could be 80, 85 as we've been talking about, it could be 90. The number could vary. But whatever the number is, the rule essentially states this, that your age plus the years of service equals a certain number. So if your age plus the years that you've been in service in that company equals, in this case, 85, then you are eligible for an early retirement. And that means that you would be fully vested in whatever pension program that you have been enrolled in. So the idea would be you could retire without losing any benefits that you would be eligible for. So let's say you're 55, you've been working at your company for 30 years, 55 is your age, plus 30 years of service equals 85. In that case, if that employee is 55, has worked for his company for 30 years, and if that company has a defined benefit plan with this provision, then that employee would be eligible for an early retirement at the age of 55. So this is often part and parcel of an early retirement plan. So simply stated, the rule of 85 basically takes the age of the employee, adds it to their years of service, and then asks the question, does that number equal 85? If it does equal 85, then they could be eligible for early retirement, and if it does not, then they may not be. However, bear in mind that this is a equal or greater than. So if the employee has been working at the company for more than 30 years and is the age of 55, then they would still qualify under the rule of 85. Now, there may be other provisions, restrictions, and so on that are in place. So the rule of 85 has to be viewed in the context of the total benefit plan. It has to be viewed with respect to all of the rules that are in play. So for instance, there might be a minimum age. So maybe for a particular employer, the minimum age is 57. So even if a person is 55 and has 30 years of service, maybe they still have to wait 2 more years before they can retire, not because of the rule of 85, but because the rule of 85 isn't the only rule that is operative. Contact your plan administrator for the details. Once again, as I said, these are corporate rules. These are not Internal Revenue Service rules, and that can matter, especially if you realize that certain private retirement savings vehicles, like 401ks, IRAs, are often predicated on the 59.5 rule. What that means is that if you have private retirement assets in, let's say, a 401k, the IRS says that you cannot take a penalty-free distribution from those accounts before you attain the age of 59.5, unless that is for some kind of an emergency purpose. Now, there's a caveat. I'll put an asterisk on that, and the asterisk is this. In some cases, the IRS allows a person to take a penalty-free distribution if they have severed employment ties. So, for example, if you're laid off, if you quit, if you retire early, you may be eligible for a penalty-free withdrawal at least in the same year that you retired. However, if you are not eligible for a penalty-free withdrawal and you take money out of your retirement account before the age of 59.5, it's essentially referred to as a premature withdrawal, and you can be taxed quite heavily on that. There's a 10% tax on any amount that would be susceptible to taxation, and that is in excess. It's an excise tax that's applied on top of whatever income tax you would owe. So remember, in a 401k and in a traditional IRA, deductible IRA, you would have a tax liability when you take a distribution. I'm not going to get into those things in this video. I have other videos where I talk about the IRA, talk about the 401k, and I will put links in the description if you want more information on those. But again, if an employee has attained the age, let's say 55, they've been in service for 30 years, and the rule of 85 is operative, they would in principle be eligible for an early retirement. If there are no other provisions that would inhibit that, then they would be able to elect certain retirement benefits. Now, that doesn't mean that they wouldn't have bonuses or additional benefits if they waited. So just like in the case of Social Security, you can elect your benefits as 62, but you're going to take a reduction over what your full retirement benefit would be at your full retirement age. And if you wait until the age of 70, then you will actually increase your benefit under Social Security. So similar things may apply to your employer pension plan. You want to check with details and have a conversation with the plan administrator or custodian of that in order to make a good determination. Just because you are able to elect an early retirement doesn't mean you should. There are a number of other factors, economic and other factors, that are going to play a role. Number one would be eligibility for Social Security, the status of your spouse and his or her employment, whether or not you could get higher pension benefits if you waited, the general amount of retirement assets that you have, your lifestyle, your income to expense ratios, your projections for what your expenses will be in retirement, the likelihood that you give to needing long-term care or some other need in the future that might cause your expenses to go up, and many other things beside. But in general, the rule of 85 is useful for people to know, especially if they have access to an employer pension. If you found something of use in this video, I invite you to like the video. Please subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video. Thank you.